times. I am Mohammad Samir Sheikh, your moderator today. I am originally from Amchi, Mumbai, Maharashtra, India, in sales by profession, and a storyteller, a counselor, and a life coach by passion. And I'm currently greeting you all from Muscat, Oman. And today, we Friends Together Group Oman, in association with Gulf Education Forum, welcome you all to BizTalk, a webinar platform which aims to simplify businesses and business practices, wherein experts from various industries will provide vital and progressive information intending to enhance our businesses in ethical manner. And today is no exception. Our topic today is growing your business without loan. We all are a part of some business in several ways. Either we own a business or we work for one. And the popular business philosophies, which are marketed in the mainstream media, focus on maximizing the business growth, considering the normal or the good times, and ignoring the bad and the critical situations as the one we all are currently going through. Our expert speaker today, Mr. Tini Philip, is going to provide a glimpse on the contrarian philosophical approach of business, which ensures growth during good and bad circumstances, both the times. So without wasting a single moment, I would like to call upon Mr. Mumtaz Hussain for the welcome speech. Mr. Mumtaz Hussain, over to you.
Thank you, gentlemen. Assalamu alaikum. Good evening to you. I would like to welcome all you participants for today's webinar. My name is Mumtaz Hussain, hailing from Mangalore, India, now live in Qatar. It's my privilege to extend warm welcome to our main guest speaker, Mr. Tini Philip from Kerala, India. As I can see, we have a lot of participants are joining. Now it is about 135. We are expecting about 200 participants. That is beyond our expectations. This webinar would not have been possible to conduct without your participation. And therefore, I once again welcome to you all. Today's webinar on the subject growing your business without loans is being organized by jointly Friends Together Oman and Gulf Education Forum, having its members in various Gulf countries. Dear friends, I take this opportunity to introduce our guest speaker, Mr. Tini Philip. Although he is an eminent personality in professionals and professional trainer circle, still I need to introduce you for your benefit. Mr. Tini Philip, BTech in engineering and postgraduate diploma in management from IIM Lucknow. He is known as contrarian consultant in business circle for his unorthodox views on management, like growing business without loans, limiting growth during boom period, equal focus on productivity and growth, increasing ROCE, yani increasing return on capital employed, taking limited market share, not running all functions and department at maximum efficiency, etc. 28 plus years as a business advice to many innovative businesses that have experienced continuous long-term success and do well both in boom period as well as recession period. He has written 100 plus articles for entrepreneurs based on his unorthodox approach in Kerala's leading magazine, business magazine, Dhanam. He is author of the Kindle book, The Contrarian Approach to Business, The Low Risk Approach to Success, which is available on Amazon. Mr. Tini is founder and CEO of Results Consulting Group, He is also director in Secura Investment Management India Private Limited, the promoter of India's first SEBI registered Sharia compliant real estate venture capital fund. He is general partner in Mount Judy Venture LLP, the promoter for an ethical venture capital fund that wishes to create wealth through mutually fair and equitable venture capital investments. That's about Mr. Tini Phillips' introduction. I welcome you, sir, for today's webinar. Yes, sir.
Before we begin, Mr. Tini Philip, before we begin, we just need to have a poll, which will be appearing right now on your screen. I just request all the participants to answer this poll. There are a few questions which you need to answer before we can start with Mr. Tini Philip. Mr. Shahjahan, Mr. Magdoum.
Finish. Let me finish.
Yeah, Mr. Mumtaz, please go ahead.
Businessmen do associate with conventional banking system in India and most part of the world also. In Gulf countries and Muslim countries, businessmen depend on conventional banking system as well as the Islamic banking system. In UK, Standard Chartered Bank has Islamic banking system in select branches and people do deal with them. Now it's a game changer, growing your business without loans. We shall listen to Mr. Philip on his expertise. There are many success stories on some business establishments who have adopted his theory. So let us listen to him, and I hope you are also enthusiastic about it. Once again, I welcome you all. Over to you, moderator, Mr. Mohammed Samir in Oman.
Yeah. Thank you, Mr. Mumtaz Hussain, for that welcome speech. We would like to take the next poll. Mr. Magdoum, if you can post the next poll.
This was already on. Just wait.
That's it. That's the only one you want. Okay.
Wait.
Yeah.
Should I relaunch the poll?
Yeah, if you can. There are two questions, right? There's one I think is answered. One more is left.
Second one, okay. Sure.
Yeah, all the participants can review it. So if you own any kind of business, you're an entrepreneur, or if you're, any kind of business, you can just tap on yes. And if you're employed, you're working somewhere, then you can write no. But if you're owning any kind of business, you can just select yes. Yeah, I think that will be all, I suppose. Magdoum bhai, we can end, okay?
Yeah, we'll end the poll.
All right. Okay, over to Mr. Tini Philip. You can please begin, sir.
Thank you, Mumtaz and Samir, for the wonderful welcome speech and introduction. Can you hear me clearly? Okay, so let me just share the slide first, which I plan to present. Give me a second. Yeah. So, hello everyone. It's indeed a pleasure to be interacting with such a wonderful audience across several countries today. The topic I'm going to take is called Growing Your Business Without Loans, as you can see from the slide. And, it's a subset of what Mumtaz described as the contrarian approach to business. Right? So, let me just explain these two concepts. I think growing your business without loans is well understood by everyone. It's can you actually grow a successful business over the long term without taking loans? And that's the objective of today's presentation, is to show you and convince you that it is quite possible to do this. The second part of the title is called the contrarian approach to business. I think I'll explain it a little. Basically, I believe that there are broadly two types of philosophies that entrepreneurs use for running their business. One is what I call the popular approach to business, which probably 95 to 99% entrepreneurs follow. Okay, and that is what we normally see in the mainstream. It is promoted and propagated by the management media, management theorists, the MBA schools, the business schools, most management experts, and most management writers. Whatever theories they are probably giving you or sharing with you is all what I call the popular approach to business. So the popular approach includes a lot of different ways of doing business, but within that, all these approaches, there are some fundamental principles which are the same for all the approaches which follow the popular approach. Okay, and I firmly believe that some of those fundamental principles are wrong. Okay, and they're flawed. And thereby, what has happened over the last 28, 30 years is that I have evolved the contrarian approach to business, which is a different approach, which I believe corrects the flaws that are there in the popular approach. Okay, and one of the stark differences between the popular approach to business and the contrarian approach to business is with regards to taking interest-bearing loans. Okay. So in the popular approach, in fact, entrepreneurs who follow that approach are encouraged actually to take loans. In fact, your experts would tell you that if you don't take loans, you're actually being a fool. Okay. The contrarian approach has a diametrically opposite view, in that we believe that you can actually grow your business without loans. Loans are bad for business in the long term, and loans should be avoided. Okay. Excuse me, I think there's people are writing on the screen. Could you disable that part for the participants?
Only you can disable from the sharing option. You go and there is an annotation.
Yeah.
This thing.
Okay. Yeah, I saw the annotation. So clear, right? Okay, but disable.
And you even need to disable it. You just disable it as well. Annotations, you should just disable it. Apart from erasing.
Disable attendee annotation, right?
Yes.
Okay.
Yes.
Okay. Is that clear? Okay. So for me, today's presentation would be worth its while if amongst the business people that are there today who are present, and those who are actually using loans for their business, if at the end of this presentation, even one of you actually takes a call that you would like to change your policy and you would like to attempt to run your business without loans, I would be fully satisfied with the kind of effort that I'm putting in today. Even if one person gets that idea that he can actually run his business without loans, right? So let me just go to the agenda for today, the structure of the presentation. I believe that at the end of the presentation, there will be a Q&A session, so that is understood. But the presentation structure is as follows. I will first talk about the ancient civilizational view on interest-bearing loans, and the spiritual view in terms of, I will talk about what major religions say about interest-bearing loans. Then I will look at why taking loans are bad. Why do I believe that loans are bad for business and people should not take loans? And why do people still take loans despite the fact that even spiritually it is not recommended ideally, and also the fact that taking loans in the long term is not really good for business. But why do people, vast majority of people who follow the popular approach, as I said, 95 to probably 99% of the people doing business, tend to still take loans. and how practically can a person, a businessman who is actually growing a business, how can he avoid loans? What is the fundamental principle or the fundamental things that he should implement in order to ensure that in his business he can avoid loans and still grow? Okay. And this is all theory. So what I'd like to do at the end of the presentation is talk about a practical case study. And this case study is based on a real life client of mine. It's a client which I'm still working with. We've been working for about 15 years. I've been working with them for 15 years. And this client, when I started working with them, they were a very, very high debt company, successful, but very, very high debt. And over the period, we have done exponential growth or steady growth along with, moving them to a zero debt scenario. So it's a simplified case study to give you the concept so that, and it's a normal business. It's a manufacturing with a distribution, with their own distribution kind of setup based in the state of Kerala. And this company is very successful. We have grown nearly 30 times in about 15 years, and we are currently the third largest FMCG player in Kerala, with in the segment that we are playing in. Okay, so this case study is a practical example, although simplified, to convince you that it is actually quite possible in most cases to switch from a high debt business to a zero debt business. It's not easy, it takes time, but it is actually possible. And finally, to inspire you, I will just give you a few, I'll reel off a few names of big businesses in India which are actually running on zero debt, because there's a common fallacy or belief that all big companies, run on heavy debt. Once you become, especially listed companies, the bigger you are, a listed company, the bigger the company, you avail debt, is what is commonly believed. Okay, so this is the structure of the presentation, and as I mentioned, at the end we will have a Q&A session where you can try and you can clarify any doubts you have, or you can ask me questions. So let me first start off with the ancient and spiritual views related to interest-bearing loans. Now, why are ancient and spiritual views important? I believe that when you're taking a policy or an approach or a path which is not popular, where most of the people around you actually don't believe in what you're doing, and your peers, your friends, even probably maybe your family, your competitors, nobody believes in the path that you're following. It's very difficult to follow that path. And it's only when you achieve success that you're able to follow that path. And the greatest danger I see is that once you achieve success, then it's very easy to stray from the path. Because, for example, in terms of loans, if you're a very, very successful big business, all banks will come to you, telling you that they can give you loans. And it's very easy to fall to temptation and, go back to loans. Okay, so to help you stay on this narrow path or righteous path or this difficult path, where thousands of people will be talking to you and trying to brainwash you effectively to change your path and to go with the popular trend, having a moral backing or a moral feeling that what you're doing is right definitely would help you in sustaining this path. And that is the reason I am actually, talking about the ancient and spiritual views in a business presentation as such. Okay. So let me first start with, the ancient civilizations' view on, interest-bearing loans. So in the ancient civilization, usury was defined as the practice of charging financial interest in excess of the principal amount of the loan. Okay. So in ancient days, any interest, whether low, medium, or high, was considered to be usury. Okay. If you gave a loan and you took back only the principal, that was okay. But if you charged any sort of interest, it was defined as usury and it was frowned upon. Okay. So this is the ancient definition of usury. Any interest-bearing loan is bad. So what is the modern definition of usury? It has changed. Okay. So usury is now interpreted as interest above the legal or socially acceptable rate. Okay, so what has happened is basically interest has been legitimized. Okay, so if you charge normal interest, okay, which is defined as anything below the legal or socially acceptable rate, then it's no longer usury. Okay, usury is only when the interest rate is above, the normal or legally approved rate. So the modern definition is a very, very big dilution from the ancient definition. So today when people talk of usury, we are talking about high interest rates, or in colloquial language, blade interest. When somebody charges you extreme high interest rates, then you say that is usury. But normal interest rates that the bank charges or anyone charges you is considered to be okay. Now, if you look at the various spiritual views, and I'll be looking at a few religions, major religions across the world. The first I'll take up is Hinduism. In ancient Hinduism, in 400 BC, Vashishta, a well-known ancient Hindu lawmaker and rishi, actually forbade the higher castes in those days, the Brahmanas, priests, and Kshatriyas, warriors, from being usurers or lenders at interest. So he forbade them from giving any money at interest. So usury in those days was defined in the old way, any interest. Okay, so it was considered to be bad, for in ancient Hinduism in the time of Vashishta, the law that he provided or the advice that he gave the higher caste was, do not give loans on interest. Okay. What about modern Hinduism? So as Hinduism progressed, by the 2nd century AD, the laws of Manu came out, and it is in the laws of Manu, it says that stipulated interest beyond the legal rate is being against the law, cannot be recovered, which means that is again here interest has been legitimized. As long as it is not beyond the legal rate, it's okay. And if it is beyond the legal rate, then you cannot recover that money from the debtor. Okay, so modern Hinduism compared to ancient Hinduism, we are seeing a significant dilution in the stipulation against interest-bearing loans. Look at Judaism. So ancient Judaism, the criticism of usury in Judaism has its roots in several biblical passages in the Old Testament, in which the taking of interest is forbidden, discouraged, or even scorned. Okay, so ancient Judaism, several places, it is mentioned that you should not take interest. Interest is forbidden. Unfortunately, modern Judaism has diluted that stipulation. So today, Jews are not allowed to charge interest to other Jews. And so therefore, non-Jews can be charged interest by Jews. So this is how it has been diluted in modern Judaism. If you look at Christianity, okay, I'm a Christian, so my faith, ancient Christianity actually forbade taking of interest. In the 5th century AD, the Roman Catholic Church, which was most of Christianity at that particular point of time, prohibited the taking of interest. Okay? And in the 8th century AD, usury was proclaimed a general criminal offense. Okay? And usury had the old definition, any interest. Okay? And in as late as 1311, Pope Clement V made the ban on usury absolute and declared all secular legislation in its favor null and void. Now, what does this mean? In 1311, Christianity was mostly focused on the Western European countries. Okay, and so you had the Pope in Rome, who was the supreme leader of the religion, and you had different kings ruling various kingdoms. And the kings were anointed by God. That was the theory. But they used to pass laws and regulations within their own country. But ideally, it should not go against the tenets of the church. So in this particular instance, Pope Clement actually prescribed, he banned usury in such a way that if a king in a country legitimizes interest, the people of that faith in that country, which was most of the people were from that faith, could actually refuse to obey that law, and they would have the sanction of the church. So this was this is the situation with ancient Christianity even till 1311. What about modern Christianity? So today, modern Christianity, Christians are not allowed to charge high interest, okay, which is the modern definition of usury. So we are told that we should not charge, in colloquial terms, what I call blade interest. Okay? But charging interest at normal rate is allowed in modern Christianity. If you look at Islam, the criticism of usury in the Islam is well established in the Holy Quran, dating back to around AD 600. Okay, but as in all religions, what I'm seeing is that there seems to be a dilution even in Islam. So we look at Sharia compliance, right? So Sharia compliant companies are supposed to be free of unwanted or wrong activities. So the definition of Sharia compliance is actually changing. Okay, many mutual funds, financial advisors, and even religious scholars actually define Sharia compliant companies related to debt or interest differently today. As an example, HSBC Amana, okay, which is a Malaysian-based company, their definition of Sharia compliant company is it should have a total debt less than 33% of the 12-month trailing market capitalization. So if it's a listed company, it has a market cap. And in most cases, the market cap is much, much higher than the equity. Okay? So what is allowed in their definition is that as long as the debt is less than 1/3 of the market capitalization of that company is Sharia compliant with respect to the clause of interest. Okay, so this is a definite dilution in the original theory of Islam, in which interest is haram. Okay. So what I'm seeing, when I studied all these issues, what came to mind was that a clause or a saying that is God proposes, man disposes, and rather than that, I believe it is God proposes and man dilutes. Okay, so I think that virtually all religions in the world and all ancient civilizations have pointed out that interest-bearing loans are bad, okay, and scorned. We have been asked not to do it. But over the last probably 600,000 years, every religion, every civilization has diluted that concept. And now, depending on which religion you're from or which civilization you're in, in some places interest, it's like normal interest is allowed. In some places, a percentage is allowed. Loans, a percentage proportion of loans are allowed. Okay, so in fact, we have reached a situation where today I'm led to believe that the debt to GDP ratio of the world is at the highest ever in known history. Okay, and we don't know, I mean, how this is all going to play out, because most of us have very, very short memories when we look at civilization, the times of civilizations, which is thousands of years. Most of us get to live probably between 70 to 50 to 90 years. That's about the max we can we experience. And most of us do not really study history properly to understand what happened thousands of years ago. And to some extent, that kind of documentation is not available. So God proposes, man dilutes is the common trend that we are seeing across the world, and which has led to a very dangerous situation of an extremely high debt to GDP ratio in the world today. So let us now come to the point about why I believe loans are bad. Now, my evolution into this concept was not from my religion, because as I had explained earlier, modern Christianity, actually frowns upon high interest. So I was taught that normal interest is fine. I moved into the zero loan camp because of the effects that I saw on businesses, the negative effects of loans on businesses. And that is what I will try and explain in these slides. So we have on one side the moral part, which is the spiritual issue, but there's also the practical part, what is actually wrong or what is actually bad about taking loans. So I'll try to explain that in this section. The first thing that that strikes me when people take loans is that it seems as if people, when they take loans, they believe that recessions will never happen. Okay, and this typically happens during boom times. So I think we have a very, very short memory. Most people, we can't think beyond 2-3 years backward. So if the last 3 years was boom time, then we automatically extrapolate that to the next 1,000 years is boom, boom time. And if the last 3 years was bad times or recession times, the next 1,000 years is also a recession. So I don't know why this is so, but that is how most people are made up of. Made up, minds are made up. And I have a joke, which a very funny story, which I think probably explains this concept. It's like I believe that we are all descended from our ancestors, right? So let's say thousands and thousands of years ago, we had our ancestor. Each one of us had his ancestors living in a very primitive society. where we were like, if you're in India, you could be attacked by a tiger and eaten. Okay, so all the people who were living in those times, let's say you had two types of people. One, people who took instantaneous decisions and and reacted, and those who contemplated and studied and analyzed before they took decisions, right? So let's say you had two people like that, and both of them saw a tiger. So our ancestor probably would be the guy who looks, sees a tiger in the distance, and he thinks it's a tiger. He just, he's not sure, but he thinks it's a tiger, and he runs up the tree, okay, to escape the tiger. Okay, whereas the other person is an analytical person, a thinking person. What he does is that he analyzes: is it really a tiger? Let it come closer. Let me just double check. And once a tiger comes very close, he figures out that okay, this is a tiger. But then by the time it's too late, okay, the tiger eats him. So basically, we are descended from people who, the moment they thought they saw a tiger, they ran up the tree and escaped. Okay, the other guy doesn't have any descendants because he would have been eaten by the tiger. So our minds seem to be hardwired to taking quick decisions and reacting very fast. So if the last couple of years was very good, the next 100 years are great. If the last couple of years were bad, the next 100 years are also bad. So what happens is when when in boom times you find people availing of loans, and what happens is that it seems to be as if recessions will never happen. Okay? And recessions are normally multi-year events. We are going through a recession right now. India, we've been going through a slowdown for the last 3-4 years. 2008-9, we had a worldwide recession, and so recessions do happen. Okay, so when we take loans, we have to understand that recessions happen on a regular basis, and recessions are multi-year events. So what happens during recessions? So what happens is that the weak businesses normally close down. So recessions are, sales go down, market shrinks, and margins go down. Okay, so the weak businesses normally exit. That's what happens in every recession. Okay, depending on the severity of the recession, the number of businesses, the percentage that close down change. If it's a mild recession, a few percent, maybe 5-10% businesses close. If it's a major recession, maybe 20-30% of businesses close. And if it's a really great depression, you would have 40-50% of businesses closing down. So what's the there are many reasons for being a weak business, but one of the major reasons of being a weak business is very high debt. Okay, so if I have a business with the start of a recession is having very high debt, I'm weak, okay, because my overheads are high. I have to pay interest on the debt, so I have extra overhead compared to a competitor who doesn't have any debt. And in many cases, very high debt. Most people have also taken term loans. Okay, and the term loans you have to pay EMI, okay, equated monthly installments. Now EMIs are very dangerous because EMIs consist of repayment of principal along with an interest component. And in our profit and loss statement, only the interest part comes. So if I'm paying, let's say, 1 lakh rupees a month on EMI, maybe my interest is 10,000 or 20,000 rupees, whereas 80,000 is the principal repayment. Okay? And so in my P&L, I will only show 20,000 rupees, whereas in my cash flow, I will be showing 1 lakh rupees. Okay, so many people fall into this trap, and banks give loans up to a limit, and then when you ask for too much loans, they immediately convert these extra loans or give you loans as term loans, where you have to start paying back principal. Okay, so this is a very, very high burden on a business during a recession. When you compare it with a business which doesn't have term loans or working capital loans or virtually zero loans, you have an additional expense and an additional cash flow which your customers may not be willing to pay for. Okay? So a very high business equals a very high debt business is equal to a weak business, especially during recessions. Now, why do many people who take loans end up with maximum possible loans? Okay. The reason I believe is because debt is addictive. Okay. And when I say addictive, it's like drugs. Okay. You keep on taking it. And let me just give you two scenarios, two types of entrepreneurs who are taking loans. The first entrepreneur, let's say, is is not so disciplined, and the second entrepreneur is actually quite disciplined. Well, the first entrepreneur, the business is growing, boom time is happening, and he takes a loan. So we have a collateral-based loan system in India, and so what happens is that if I'm running business and I have assets worth, let's say, 5 crore, and this is a boom time, I'm selling more, I need to give credit, I need to stock up on raw materials or finished goods. So I require capital, or I require money, and the money required is more than my profit. I'm trying to grow fast. So then obviously, the easiest way to get this money is to, let's say, take this, I have 5 crore worth of property. I take 2 crore and, give it to the bank, and I take 1 crore loan for that, for the requirement that I have. So I start off like that. And if I'm indisciplined, what I tend to do is that as I grow, even during good times, I keep on taking loans. So every time I start to grow, I don't increase my productivity, or I don't try to reduce my requirements. I go with the flow. And in fact, in some cases, I utilize my funds less efficiently. So I spend more, I invest more to do the same business. That happens in many cases. And so what happens is, ultimately, if I have a 5 crore collateral and the bank is willing to give up to 4 crore, I will end up with a 4 crore loan, even during the boom time, even before the recession. Okay, so that's one kind of person. And what happens, one kind of businessman. And when the recession starts, I'm already at maximum loan. And as I had mentioned earlier, I am a weak company, and the chances are that I will, not survive the coming recession and close down within the first year or two, because I'm already at maximum loans. The second type of entrepreneur is
Mr. Tini Philip, there's a suggestion from the audience. Your mic is actually, touching the button, and it's creating a lot of disturbance.
Oh, okay. Sorry.
You can just manage that in some way, because it's creating a lot of disturbance.
Shall I remove it?
Thank you.
Just hold on. Yeah. Can you hear me better now, or is it okay?
You need just be a little louder then. Just a little louder.
Okay. Is that better?
Yeah, yes, this is better. This is better now. Yeah, this is better.
So the second type of entrepreneur, what I had mentioned was, he's a disciplined, more disciplined person. And, when he takes a loan, like he took the first crore loan, the same example, he had a 5 crore asset. He took a 1 crore loan when he was booming. And he decided that he's going to keep his loan, only at 1 crore, or at a minimum. Let's say his debt equity ratio, he's going to keep it 1:3. So you have, entrepreneurs who actually believe that they should control their loans and manage it properly. And let's say that is the second type of entrepreneur. So he reaches the recession with a reasonable loan, not like the other entrepreneur who is actually having a very, very high loan. Let's say this entrepreneur has about a 1 or 2 crore loan. Now, what happens is the recession hits him, and normally, as the same issue happens, margins go down, and the market shrinks. And so, what happens there is that there's a good chance that this entrepreneur also goes into a loss. Maybe not as much as the first entrepreneur, but the possibility of going into a loss is still quite high. So, let's say he loses about 1 crore of rupees in the first year of the recession, but he's doing okay. His working capital is eroded by about 1 crore. But he, what happens in this kind of case is that instead of taking the hard decisions, because you have this loan option available, what we see with these kind of entrepreneurs is that what he does is, okay, next year will be better. And that's another point which I think I should touch upon. Entrepreneurs are basically positive people, very positive. So they always think that things are going to get better. Otherwise, it's very difficult to get into entrepreneurship because it's a very difficult game. So, entrepreneurs, like, it's very clear, demonetization, GST in India happened. It was very clear to me that the Indian economy was slowing down and would continue to slow down for 3-4 years. We did not expect COVID. But what we saw generally in the market was, I would say 95% of the entrepreneurs believed that the market was booming, after GST and demonetization. Because, the figures that are released were not accurate. The government figures that's a different part. They're not very accurate. They don't consider the unorganized sector. And, people were acting on that. Very few entrepreneurs actually figured out that the market was actually slowing down. The economy was slowing down dramatically. And in fact, my belief is that India was in a recession just before COVID, pre-COVID. Okay? So the actions are very different. So when you're positive, if you go into a recession,
your automatic belief for most entrepreneurs is to believe that next year will be better. So why take the hard decisions? Take the easy way out, which is, take an additional 1 crore loan, and the bank would definitely come and push it to you because you're a decent business. You have, he knows you have collateral to spare. And so what happens is the next year, second year of recession, this businessman takes 1 crore loan to fill his working capital gap. So now he's got a, let's say, 3 crore loan. He had a 2 crore loan. Now he has the 3 crore loan. If the recession continues, and I had mentioned that most recessions are multi-year. Okay, the second year recession happens. Now he's in a weaker position than he was at the beginning of the recession, because instead of having a 2 crore loan, he now has a 3 crore loan. So what normally happens in the second year, his loss will be even higher. So probably he'll lose about 2 crore. Okay. So at the end of when he loses 2 crore, he again is not in a position to take any hard decisions. So he again tries to get loans, and he ultimately ends up in the similar position as the first entrepreneur, especially in a multi-year recession. Okay? So probably by the third year, he is in very, very dire straits. Okay? So these are two examples, and it's very, very difficult for a person to control debt. Okay? So some people, they're not disciplined at all. So even in boom times, they would probably maximize their debt. But even those who believe they're reasonably disciplined, we find that when circumstances change, they run into a loss, especially during a recession, and they believe things will turn around the next year. They tend to maximize their debt, or take more maximum loans, which again, sets them up for failure. So how would an entrepreneur who follows the contrarian approach, act in this situation? The contrarian approach does not believe in loans, right? So there's no question of taking loans. So what happens is, if I happen to run a loss, first of all, as a contrarian entrepreneur, I would not be looking at the end of the year and seeing that I have a loss and, what should I do? Every month I would be checking whether I have a loss, whether I have negative cash flow. And if I have a loss or a negative cash flow, as a contrarian entrepreneur with loan option not available to me, I would immediately take the hard decisions required to ensure that I have positive cash flow and I have profits. Okay, so I normally would not get into such a situation because of this easy way out option. Of course, I could close down due to other reasons, but normally this reason, debt, because of loans, the chances of closing down for a contrarian entrepreneur are zero, because we don't believe in taking loans. Another negative aspect of taking loans is that what we see, with people who take loans in boom times is that they try to grow, very fast during boom times. I'll give you an explanation for that later. But this is a typical graph of a company or a business which takes loans. So if you look, it's on the x-axis is the years. I've taken about 6-7 years, and on the y-axis is sales in crores. So let's assume this company started off in year one with 100 crores sales, and started to take loans. So it was a boom time. So this company accelerated its growth, grew by 50% to 150 crores in the second year, and then to 175 crores in the third year. And there it took a lot of loans. And then by the third, fourth year, we started seeing a slowdown or a recession. And because this company is weak, okay, the fact that if you're weak, you can close down. But let's say this company doesn't close down. What normally happens, it escapes with the skin of its teeth. What happens is that you normally see such companies shrinking, okay, because they have to cut unviable divisions, they have to cut or sack people, they have to close unviable factories, unviable branches, and so they degrow or they shrink. So in recession time, this company would go from 175 to 160, and probably from 160 crore to 140. Okay? And then let's say the recession tapers off and we start growing again. Then again they grow to 170, which is a 21% growth. 21.4%, and then ultimately reach 200 crores, in year 6 or 7. So if you look at this growth, it's actually very poor long-term growth. The average is about 10% annually. Okay, but most people don't realize this is what is happening. In fact, I've had many examples. I had a very good example a few years ago, where I had a client coming to me, potential client, and he was in the crane business. So he, most entrepreneurs look up to the listed companies as examples that they want to follow. The big listed companies in their industry are the ones they want to emulate, because they believe that those industries, those companies are actually very successful. So he came to me and said that, his demand was that I need to advise him so that he could become like Sangvi Movers Limited, which is the biggest listed crane company in India. Sangvi Movers, you can check it out. Okay, so I told him, I mean, are you really sure that you want to be like Sangvi Movers Limited? He said yes. So then we researched and we put together the growth rate of Sangvi Movers Limited. It was something like this. And the figures are different, but it grew a couple of years, high growth, several years, negative growth, several years, very minor growth. And the debt equity ratio at the beginning of that period was 3:1. So he was shocked. He said, no, this is wrong. I said, why? He said, Sangvi Movers, I remember reading that, it grew by 50% in a year. It's 50% a year and it was growing tremendously. So these figures are not accurate. I said, look, these are public figures. I said, look, this 50% growth was reported as headlines. Okay. But the minus 12 or minus 20% growth, is reported in the inner pages of the Economic Times. Okay. So what happens is that, more people, you tend to see only the headlines. And so a lot of people believe that most of these big companies, do super growth every single year. That is not the case. Most of these companies, they grow during boom times and they actually shrink during, recessions. Okay. So they have, apart from the problem of having a high failure rate, if you take loans and you follow this philosophy, you normally have a poor long-term growth. You have high growth during boom times, and you normally shrink or have a degrowth during recessions. So, despite spiritual issues, ancient views, despite the fact that many people actually realize that loans lead to failure, and many people may not realize about this longer slow growth. But if you look at all these negatives, why do we still take loans? Why do the vast majority of businesses still take loans, and why do the vast majority of management experts actually still encourage people to take loans? Even chartered accountants, I've heard people telling me, or telling my clients that you take loans, your interest, you reduce your income tax. I mean, many reasons are given for taking loans, and one reason is that you don't need to pay so much income tax. The interest would be written as an expense. Okay? So why do we still take loans? I believe it's because people, practically are forced to take loans. The way the way they run their business, it gives them no other option but to take loans. And this is what I will try to explain in the next session. So in the popular approach to business, which I had mentioned, which I believe 95% of businesses follow, one of the fundamental tenets is that you should grab the growth opportunity in boom times, accelerate your growth during boom times. And the reason for that is they firmly believe that in recession or in bad times, when the market shrinks and when margins go down, it is very difficult to grow. And their experience has been that most of them shrink during recession periods. Okay. So now every business wants to grow. Most businesses want to grow steadily and they want to reach somewhere. If you're a 100 crore company, you want to be 200 crore after so many years, you want to be 300 crore and so on. So if you understand that recessions are there in between this whole period, and your growth is going to be very restricted during recessions, and or you could shrink, then how do you reach this target? Okay. So the solution to that is overgrow or excessive growth during good times or boom times. Okay. So this is a very, very fundamental principle that is followed by people who use the popular approach to business. It's one of the three fundamental principles. Okay. And the reason is because they believe they cannot grow during recessions. So all companies have limited management bandwidth. Okay. You are the owner, you have key managers, key supervisors. We have a limited management bandwidth. We don't have infinite bandwidth to manage our company. And most of the bandwidth is actually used for day-to-day operations. So I put in this pie chart that let's say 60% of our management bandwidth is used in day-to-day operations. It's actually low. I think in many companies, even 70-80% of their time is spent on day-to-day operations. So you have a balance, let's say in this example, 40% time where you can use for other things apart from day-to-day operations. So if you're going in for excessive growth during boom times, you find that most of your spare capacity of bandwidth is used for growth. So in this example, I put 35% out of 40% balance is used for managing growth. And therefore you will have a very negligible part of your bandwidth, negligible management bandwidth, which is used for things like productivity improvement, okay, which improves your rotation, improves your returns, changes, improves your business model. Okay, so what we find is that people who use the popular approach, especially during boom times when they grow too fast, they end up spending most of their spare capacity of management on growth and very, very little on productivity. So what that means is that in those kind of companies, you find that the returns that they generate are low. Okay, so returns are measured in two ways in most companies. It's return on equity, which is ROE, which is the net profit divided by the shareholders' equity or investment in the company, and the ROC, which is return on capital employed. Now, I prefer ROC because most loan businesses take loans. So therefore, we need to consider loans as a source of funding. So in this method, we take EBIT or net profit plus interest plus tax as the numerator, and we divide it by shareholders' equity plus long-term debt. Okay, this is the capital employed. Okay. My definition of ROC is actually a little more stricter. I also consider short-term debt and even supplier credit as part of capital employed. So when I look at my clients, I consider any long-term, short-term, and even supplier credit given to that company as capital employed. The reason is very simple. If a supplier is giving you 1 month credit, then of most cases, if you pay him ready cash, he is willing to give you a discount, which means that this credit comes at a cost. Okay, so it is not free. Unfortunately, many entrepreneurs seem to believe that supplier credit is free. It's normally not free. There's a cost to it. So if you're able to negotiate a better rate, better terms by paying more promptly, then supplier credit has a cost. So in my opinion, it also has to be treated as a investment in the company. Okay. So people who follow the popular approach, who go through excessive growth during boom times, they don't have management time to spend on productivity improvements. Invariably, they end up with low returns, which in this particular case means low ROC, return on capital employed. So there's a very ROC. It's very funny. There seems to be a glass ceiling for ROC or an upper limit. So in India, I see that most companies average ROC is about 15% as per the conventional definition, not my definition, which is more stricter. 15%. They're okay. EBIT by EBIT by shareholders' equity plus long-term debt, 15%. That's about the limit. It seems that most companies are not able to go beyond that limit. So if you study this, there's a reason. So in India, the bank interest rate is about 10-12%. So this 15% is about a few percentage points more than the bank interest rate. Across the world, if you go to a developed country where the interest rates are maybe 4 to 5% bank interest rates, you will find that the ROC is about 3-4% higher than maybe 8-9%. And if you go to a company, an undeveloped country or a country where the bank interest rates are high, let's say 17-18%, you will find that the ROC in those countries are another 3-4% higher than that bank interest rate. So it's like, I don't know how to put it, bank interest plus 3% is about the higher limit of ROC that all companies sort of follow, most companies. The reason for this is very simple. If I'm taking a loan from the bank at 12% interest, ideally I should make at least 12% on that so that I can pay off the interest on the loan. If I make lower than 12%, then I will have to take the profit that I make from my capital that I've invested and give it to the bank, which no entrepreneur is happy to do. So 12% would be, it's zero profit, zero loss. Whatever I've made because of that money, I pay to the bank. That's also not a good situation for most entrepreneurs. So it's something like, okay, 12% interest. If I make 15% ROC on that money, I get 3% free. I pay 12% to the bank and 3% comes to me free. So what happens is all entrepreneurs who are successful or who run for many years and not close down within a year or two, who run for a significant period, ultimately and somehow reach this ROC range of plus 2 or 3% above the bank interest rates. Otherwise, they would not survive. But what I see after that is that people who follow the popular approach, maybe because they don't have the time, as I said, bandwidth is limited, they don't try to improve this figure beyond 15% in India as such. So if you look at the, you can check this with checking the listed companies figures. There are 6,000 listed companies in India approximately. There are about 6 lakh medium-sized enterprises, and there are about 6 crore micro enterprises. So the 6 lakh, if you look at the 6 lakh listed companies and check their data, you will find virtually, I would say, virtually all the companies that are making profits, their ROC would be in the range of 15% or lower. And there are hardly any companies which are able to exceed 15% ROC every single year. It's very rare. Okay, so these are the best of the best companies in India, or what people believe are the best of the best companies. And their ROC is about 15%. And I find that also for smaller companies, especially those which take loans, they also tend to hit this upper limit of about 15% on the average, because they don't really strain to push their ROC above that. The main reason I believe is that they don't spend the time on productivity improvements, which would help increasing the ROC. So now, why is it compulsory, or why does it become a compulsion for the businesses that follow the popular approach to take loans? Now we have understood that those businesses or entrepreneurs which follow the popular approach tend to go for excessive growth, especially during boom times. So that's the right side, excessive growth, Y%. And because of that, they are unable to focus on productivity improvements, which means that their ROC is low, so X%. So if your ROC percentage is less than your growth percentage, which is what this scenario is showing, in order to grow, you need to take loans because you don't have sufficient profits to fund your growth. Okay, I think this will be more clear if I give as an example I've shown an example, we can go through that. Let's take an example of a zero loan business, a business which didn't have any loans. But this entrepreneur is not doing any significant productivity improvements. And he has employed 10 crore capital in his business today. And his ROC is about 15%. Okay. You can see these figures on the left side of the slide. And let's say, so his approximate net profit is about 15% of 10 crore, which is about 1.5 crore. That's his profitability. And now he wants to grow at 30% next year. It's a boom time. He decides he wants to grow at 30%. Now, in order to grow at 30%, his turnover has to go back to 30%, which means with no improvements in productivity or change in business model, he will need 30% more capital employed. So that means 10 crore is his current capital employed. He will need 13 crore, another 30%, which means another 3 crore. So additional funds needed is 3 crore to grow at 30% next year. And his current profit is 1.5 crore. So definitely he has a shortage of funds of about 1.5 crores. And this is what causes people to go in for loans, because this 1.5 crore would be funded through loans. Okay, so the fundamental reason why most people go in for loans is that they have a low ROC and they have a much higher growth plan compared to their ROC. X is less than Y. Thereby, they are forced to take loans in order to grow their business. So let me just now look at how we can avoid loans, because this is the theory which proves that if you follow this kind of approach, you want to grow, you have actually no way out but to take loans. So how to avoid loans? Because this is, I think, an interesting part which everyone would be interested in, looking forward to. It's actually quite simple. So let's go to it. So in the contrarian approach to business, we believe that you actually can grow in recessions and boom times. You can have a steady growth every year if your company is strong and you're innovative. So what does it mean? We can have a good long-term growth prospect. It means I can grow steadily in boom times and I can also grow steadily during recessions. So growing steadily in boom times is not a big issue, because we all know that in boom times, the market expands, margins go up. There's a lot of scope for any strong company to grow. How do you grow in recessions? So what we are seeing, we are in a recession right now, and most of my clients are doing extremely well. They're growing. is that in recessions, after the initial phase, a lot of companies start closing down. And depending on the severity of the recession, the percentage of companies closing down goes up. And as these companies close down, we find that there's a lot of opportunity for a strong company to actually grow. And when I mean a strong company without loans, company with high ROC, we are able to, because in recessions or slowdowns, pricing becomes very, very important. People want value for money. They want good products, good service, but they want it at a lower cost if possible. I mean, those of you who've been visiting India or, even the Gulf, over the last 2-3 years, the Gulf has been going through a recession since 2015, a slowdown because of the oil price. If you look at your supermarkets, maybe 3-4 years ago, I used to see offers like buy 5, get 1 free. After some time, you saw buy 4, get 1 free. Then you saw buy 3, get 1 free. Buy 2, get 1 free. And pre-COVID in India, at least, my clients, we were even offering buy 1, get 1 free in FMCG. And in one meeting, I remember pre-COVID, I think it was February, we were discussing in FMCG, like soaps, buy 1, get 2 free. How do we give that to the clients or customers without affecting our profitability or quality? So if you're a strong company, it is actually quite easy to grow in recession. In fact, I would say that it is easier to grow in recessions to some extent because people are available. A lot of people are unemployed. You get very good people. Assets are available at very low prices. Rent. You want to rent a building. You want to hire vehicles. They're all cheap. People are cheap. You want to buy assets. They're also cheap. You can negotiate better prices with your vendors if you're able to pay promptly and you're able to show growth. So we actually find growth in recessions to be a little more easier than growth in boom times, because in boom times we are also competing with a lot of other businesses which are following the popular approach and which are doing well. So to sum it up, the popular approach business, you normally do well in boom times. You either close down or do shrink in recessions. The contrarian approach, we tend to grow steadily even during boom as well as recession. So one of the fundamental concepts in the contrarian approach to business is that we have to limit our growth during boom times. So if you look at this particular example, this company has started at 100 crores, just like the previous example, but we have limited our growth to 20% every year. So from 100, we went to 120, 144. This is during boom times. In recession, we manage because we are strong. We don't have debt. Our productivity is very high. Our ROC is very high. We are able to, penetrate the market and sell more as our competitors close down. So we go to 173 crores, we go to 207 crores, 249, and we reach 300. So if you look at the previous example, the company reached about 200 crores in this period. And in this method, we have reached 300 crores, which is a 20% average growth rate. So we don't have a 50% growth rate in a particular year, something which headlines can be written about, but we grow steadily. The other company which follows the popular approach has a lot of headlines during those periods, but ultimately doesn't grow as fast as we have in the long term. So the first thing is that as a contrarian approach to business, we believe in steady growth. You actually limit your growth during boom times. So how does management bandwidth work for us? We have the same problem. We have a limited management bandwidth. So day-to-day operations, again, take up 60% of our time, let's say. But the balance 40% of the time, we divide equally between growth and productivity improvements, because we're not growing too fast. We don't have excessive growth. We're growing steadily, let's say 20% a year. Okay, so for that, we can allocate 20% of our bandwidth. And the balance 20% of our bandwidth is used for productivity improvements. Okay? We focus. In fact, when I work with my clients, I would say 60-70% of my time is spent on productivity improvements, not growth, because I believe that if your productivity goes up, it is easier for you to grow. Your ROC goes up, your rotations go up, your innovations go up. It's much easier to grow if your productivity improvement is much better. Okay, so you don't need to spend that much effort on growing. So we sort of split our time between growth and productivity, our spare capacity. This is how a contrarian approach company would work. So how would a contrarian approach company look like? We would have, as I said, steady growth on one side, 20% growth. We would not be growing higher than that. and we would have a higher ROC. So our high ROC would be, let's say, maybe 30%. So what happens is that if the ROC of 30% is more than the growth rate of 20%, A is greater than B, then we have enough own funds to invest for our growth. There's no need for loans. I think this has become clear with the example. Let's take the same example that we took previously. We have a zero loan business, the bottom left of the slide. We are doing significant productivity improvements in our company because we have a steady growth. We only look at growing at 20% a year. Thereby, we are able to spend a significant time on productivity improvements. Because of that, our capital employed is still 10 crores, let's say, but our ROC is now 30%. Okay? So we are able to get an NP of about 3 crores, and we are growing only at 20%. Our planned growth rate is 20%. Okay? So the additional for next year's growth is only 2 crore, so 20% of 10 crore. And the profits we have is 3 crore. So we have enough funds to grow our own business without loans. Okay. So this in a nutshell is the concept that I propagate and I talk to my clients, and this is what we implement. It's actually very simple, not easy to implement because in terms of boom times, it is very difficult to actually limit your growth because the opportunities are there. But this pays off because we are in a very strong position during recessionary period to grow. And that's what we've been seeing, especially this is a very severe recession, which we have never experienced in our lifetime. And we are seeing that we are able to grow very well in this period, despite the fact that even the essential commodities or essential items, markets have shrunk or downtraded. Okay, we are seeing exemplary growth in most of our businesses. So in short, if you follow the contrarian approach to business, you normally get two benefits. One is good long-term growth rate, which I had mentioned earlier, steady growth during boom times and steady growth during recessions. And you have a very great advantage of low failure rates because recessions are not scary to us. We don't think that we would be failing because of loans. There are other things which we need to do, which I'm not covering in today's topic, which are related to contrarian approach. But in terms of loans, we normally do not fail because of taking loans. Okay, so we have a low failure rate and a good long-term growth rate. So I think this is the theory part which I've explained. I hope you've understood it. You can definitely ask me questions on that later. Let me just now talk about a case study, a real life case study, a simplified case study. It's an existing client of mine. I've been working with them for 15 years, and we have transited from a high debt company into a zero debt company, and we have grown by 30 times in 15 years, which is about an average growth rate of 20% annually. Okay, so let me just explain this case study to you. So the assumptions behind this case study are it's a manufacturing and distribution business. We are FMCG. It's soap and detergents actually, and we have our own manufacturing units and we do our own distribution. We don't have distributors. I have not considered seasonality, infrastructure, taxes, stuff in this case study. I've kept it simple, very simplified with approximate figures. I'm trying to show the principle of the concept rather than giving you a real life case study in terms of like a business case study in MBA school, because I just want you to understand the concept. So I've kept it simple. And in fact, in this example, I've kept the turnover the same. So I'm showing a turnover at the beginning when we started, same turnover with how the investments or the funding is, the difference in funding. But we have actually grown during this period, as I said, by 30 times, 30 times in 15 years. Okay. So that I have not put in because it would complicate the case study. So, excuse me. I've just taken a simplified example. Let's say, at the beginning of this model, we were, beginning of the case study, we were following the popular approach model. We had a 60 crore annual turnover, and 50% sale was pure wholesalers, and 50% sale to wholesaler come retailer. We call semi-wholesalers. Semi-wholesalers are bigger shops where when you give items to them, they sell, let's say 60, 70% or 50% of the items at their retail counter as retail. But the balance they wholesale to other shops nearby, smaller shops, whom we don't serve. So they give it to them on credit and margin and sell. So this was the kind of breakup that we had in 2005, 15 years ago. We didn't have 60 crore turnover. We had about 20 crore turnover at that time. But I'm just keeping a similar turnover for calculation ease. So assuming that we had a 6% NP in those days, so in this particular example, we would be having a net profit of about 3.6 crores per year. And this was after paying interest of 1.5 crore a year, because we were funding our business with loans also. So for this particular example, we had, let's say, 15 crore loan with an interest of 10%, and we had 15 crore equity, our own equity. So out of this 15 crore loan, we used to pay 10% interest, so 1.5 crore. And after paying that, we used to get a profit of 3.6 crore per year. This is the base case scenario. Now, the investment required in our model in those days was we had about 2 months of market credit. We used to give average of 2 months of credit in the market. It's a 10 crore investment. We had about 2 months of finished goods and WIP. So, we had branches across Kerala, and we had finished goods in our factory. And of course, in our plants, we always had some WIP. There was a processing going on. So if you took all the finished goods and WIP, it was about 2 months of stock. So that's about 10 crores in this example. And we also held about 2 months of raw material stock. Most packaging and all was local. We used to buy from India, but certain oils, certain fats we used to import from Malaysia and abroad. So long lead time, bulk purchase. So we had to hold about 2 months of average inventory, which is about 10 crore. I'm making it simple. Obviously, I'm not taking the raw material cost. I'm taking the final product cost. But just to simplify it, let's say 10 crore. So for this 60 crore business, we were investing about 30 crores. We needed investment funding of about 30 crores. I've not taken supply credit into account, kept it simple. So with this example, our ROC is, as I mentioned, our profit before NP was about 3.6 crore. And our investment is about 30 crore. So we are getting about 12% per year, which is higher than the bank interest rate of 10%. Like same thing. Our ROC is slightly above the bank interest rate. And we were operating in this mode at that particular point of time. So what actually happened is that when I started consulting for this firm, the MD's main problem, the managing director, started by one person, and his son is now involved in the business. His main problem was that he said, whenever I grow, I run short of funds. Okay, so very clear. If you look at it, we are having 6 months of investment. So for every 1 crore of growth that he does per month, he has to invest 6 crores, okay, and he doesn't make so much of profit. So that was the problem. So he said, I know opportunities there. I can grow much more, but every time I grow, I have to stop after some time because I run out of funds. And I'm already maximum. I've taken maximum loans, and loan also I can only increase as per my collateral. That was the problem. So I analyzed the problem and I told him, see, the biggest issue is that your working capital, your requirement of funds is too high. 6 months is like very high. So we need to reduce that. So he said, yeah, okay, that's correct. What do we do? So I said that, look, one aspect that we need to look at is market credit. Why do we need to give so much of credit? 2 months average is pretty high. So the final customer pays ready cash in FMCG. And our customers are retailers or wholesalers. Why do they need so much of credit? So we analyzed that. So in this case, what happened was that he actually didn't believe that we could do much because he had successfully grown his business to this level by this model. And obviously, he thought his model was good because he had reached whatever turnover, and he didn't see an alternative. So his son had come into the business. So what I told him was that the son and I will work on a pilot. We will not upset the existing business. We will keep it as it is, and we will slowly grow a new model. And if that works, we will scale it up, and we will ultimately replace the old model. He was fine with that because that's the best way to do these kind of things. Suddenly coming in and changing all, tomorrow onwards, ready cash sale and all that, your company could actually collapse. So you need to do these kind of things in pilot, with using pilots. So anyhow, his son and I worked together with the managers and we analyzed why are our customers asking for so much credit. So we realized that we dump too much stock on our customers. Customers means retailers and wholesalers and semi-retailers, semi-wholesalers. The reason is we supply infrequently. We don't have good service. People don't go regularly. We offer bulk discounts. Obviously, the wholesalers, the shops take bulk when we offer discounts. We tend to push sales at the month end to achieve targets. So at that point, we push a lot of stock into the market. And we believe that there's a belief, and that is prevalent across virtually every company, is that we have to keep the maximum stock at the retailer's end to avoid lost sales. There's no point keeping stock with us. We have to keep stock there. So we tend to, whatever stock is in the shop will be sold. Whatever stock is with us will not be sold. It's all these reasons cause us to dump stock on our customers. Another issue was that we view goods transferred on credit to our customers as sales. So if I sell on credit, it reflects in my P&L, and in my assets, receivables go up. If I sell on cash, my sales go up and assets remain the same because I've received cash. My asset cash goes up. So selling on credit and selling on sale on ready cash is treated the same in our P&L. Okay, so that is not true actually. When you sell on credit, it's actually a stock transfer. And as we have not been paid, okay, until we get paid, actually sales should not be considered. But unfortunately, our accounting system today treats sale on credit as sale equal to sale on ready cash. Now, all this put together made our customers end up holding about 3 months of stock on their end, and a lot of slow-moving items because we keep on dumping items, some of them slow, some of them fast, and the slow-moving items keep on clogging the channel, and they keep on asking for more for fast-moving items. And obviously, they don't have the working capital to fund so much of stock, so they ask us for credit to manage their cash flow. A very natural process. Now, again, market credit is unhealthy. So a lot of people believe giving credit is good, but there's a lot of bad aspects to giving market credit. The first thing is that we lose significant sales because whenever our market credit to a customer is overdue, the customer is not paid us on time, we normally block supply to that customer. So if you look at, in my opinion, 12 months of sale, probably up to 3 months of sale we don't do because that customer is on a red list, blocked list. You can't supply him because his credit is overdue. So by giving credit, what we are doing is that we lose a significant part of the sale of every customer, okay? Because there's always times when payments become overdue. The second part is the second bad part is related to our sales force. In my opinion, credit-oriented sales forces are, instead of calling them a sales force, we should call them a collection force, because up to 70% of their time is spent on collection and following up on collection in most companies, especially companies where the salesman himself has to, ensure the collection. And another unhealthy part was that since we dump stock on customers, our sales force tends to focus on larger customers who can give big orders. Because for them, there are two issues. One is that the effort required to sell to a big customer, if you get a big order, is much lower than going to smaller customers and selling 4 or 5 small orders. So effort for them, optimization of their time meant that bigger customers with bigger orders were better for them. Second issue was that giving credit to a big customer is safe, because even in our system, in those days we didn't have credit rating, credit checking, and all that. It was like mostly the managers and the salespeople would decide who to give credit to and how much. They were trusted. So if we lose money because a shop closes down and we don't get our payments, obviously questions will be asked to the salesman and the sales manager by management. And imagine that you're a salesman who has sold to a big shop and the shop closed down. And imagine that another salesman has sold to a small shop on credit and the shop closed down. So imagine the kind of questioning that you would have. The salesman who has sold to a big shop would hardly be questioned. Everyone say, oh, that was a very big shop. That guy had a big house, big car. There was no problem. I don't know, something happened. He went bust. That's a natural part of the business. But if it's a small shop that you gave credit to and he went bust, you'd be asked a lot of questions. Why did you give it to this small shop? Who told you to give it? These guys are very small people. They don't have any assets. They are not strong. So, this is there in the mind of the salesman or sales manager. So they tend, and when you're in a credit-oriented system, you don't know how to sell on ready cash. So what happens is that you tend to avoid giving credit to small players because of this risk factor. So you can be questioned if you lose money selling to small shops. So what did we do? We segmented the market. We went into the market. We talked to retailers, and we realized very quickly that small retailers have much less stock and variety. It's obvious to everyone, but I mean, you really need to go to understand the difference. And we found that they also get very poor service. Our salespeople hardly touched smaller shops because, as I said, they were focused on the bigger shops and the collection from bigger shops. And we found that the large retailers and semi-wholesalers and wholesalers get volume discounts from us and credit, whereas the small retailers don't get volume discounts, and most of our salespeople don't give them credit. So what we decided was we would offer small retailers a significant cash discount, no credit, ready cash, and we would give proper weekly support. So we started with one van, and we ultimately grew to such a level where 80% of our sales was ready cash, and our old business, wholesalers and all, was still kept as a credit, but we had reduced the credit much lower than the average 2 to 3 months that we were giving. But what happened was that we didn't mix up these two sales channels. Ready cash salesman only does ready cash. Credit salesman only does credit. Because the moment you mix these two up, manipulation happens, and it's very difficult for a credit-oriented salesman to sell on ready cash. His tendency is to give credit. So what we did is we solved that problem, the market credit issue, that way. Then we looked at our sales went up, and then the next problem was our finished goods and WIP. So I'm giving it sequentially. Actually, we had done this to some extent parallel. So what we saw was that most factories have excess capacity. In fact, our factories were not running at full capacity. Right? And the actual production time for any product was hardly, not even days, it's a few hours. But we found that our philosophy in the company was that we believe in keeping our workers and machines busy at all times, maximum efficiency. So to do that, we have something called, we're a small company. We have multiple products or SKUs going through the same manufacturing process. So when we switch over from one SKU to another SKU, we need to do a setup. We need to stop the machines. We need to clean them. We need to change the dies, and then we need to restart. Okay, so setups we lose time on setups. So typically in those days, we used to take a day to set up from the soap, from one soap to another soap. So the production manager's concept was he would avoid setups, okay, and he would insist on large production batch sizes. So he would run, just to give you a simplified example, one product a week. Next week, another product. Third week, another product, and so on. Okay, and so what happens is, let's assume that we had 8 SKUs. Then he would be running an SKU every 2 months. 8 weeks, one SKU a week. So this was not in sync with our sales. Because sales actually, every SKU happens every day, but our production is in batches and big batches. So in order to maximize our productivity, we would avoid setups and insist on large batch sizes, which meant that our production was not in sync with sales. Another very dangerous philosophy that we followed was that, in case sales were not sufficient, profits would drop, obviously. So the finance people would say that we need to improve our efficiency. So they would tell the production manager to reduce this cost. So one way to reduce cost is to increase production or continue production. We don't cut production. So we found that our factories produced to stock when sales were insufficient. Okay? So even for a particular week or two, if sales were low, he would still continue producing at the old rate, because for him, the efficiency or the cost of the factory was based on his production. Stock is considered an asset. So since our production pattern is not in line with sales, we always found that we were short of fast-moving products, because market doesn't go as per our forecast. We are not the only players in the market. That's a fallacy that a lot of people fall into when they do forecasts. For example, if a particular competitor, reduces the price or increases the margins of a particular product of this, which we are competing with, let's let's say a slow moving product of ours, we will, so a fast moving product of ours, and the competitor does something which makes his product more attractive, we would suddenly see a drop in our fast moving sales. Okay? Suddenly our product becomes medium or slow moving. And the reverse also. Let's say, a slow moving product that we were having, the competition suddenly runs short of products. For example, which happened in the COVID lockdown. We would suddenly see our slow moving product sales shoot up. So we are not in isolation in this market. Competitors also do decide how our sales play out. So what happens is that we always find ourselves short of fast moving products. Okay? And this causes demands from the salespeople to increase our stock further. And that was how we were always, ended up with very high FG stock. And the root cause of this was that our forecasts were always wrong, which was understood. We realized that forecasts can never be right. The issue was that our reaction time was very slow. This production manager is producing big batches. So, we suddenly run short of an item which he's not producing right now. He would not stop and switch over. He would wait for the end of the week before he switched over to the new product, because for him, setup time was a big issue. Now, with relation to WIP, again, if you look at WIP or the process, work in process, in most of our machines, if you put something in the beginning of the machine, a soap or a mixture for soap, it would come out within minutes at the end. Okay. But what used to happen is that we would produce in big batches. So, so everything is now batched. And batching means after testing, packing, labeling, and everything, only then the batch comes out. So what happens is that our WIP is pretty high, which means our lead time for production is also high. I cannot switch the next day because I virtually kept a 1 week batch size for my production. So if I need to change over in the middle of this week, I will not change over. I will wait for the end of the week before changing over, which means my lead time is longer than normal, and which results in poor service levels. High finished goods and work in process also leads to obsolescence and carrying costs. We have items which expire because we're holding stock and they don't sell. Of course, in this segment we have a little leeway in expiry dates, but in fresh foods and all that, you have a problem. High finished goods also causes us to offer promotions and schemes to liquidate low-moving stock, which leads to lower margins. So, holding high FG and WIP is unhealthy. And high FG and WIP causes us to limit the variety of products we offer, because the more the variety, the more the finished goods stock in this kind of scenario. And remember, we are already tight for funds. So what happened, I'll just give you an example. This is a very serious problem for us because as we expanded our sale, if I remember correctly, we were servicing about 6,000 shops in 2005. And we started expanding our coverage. And Kerala is like a big town or a big suburb, except for the forest areas. So what we saw was that in Kerala you have a lot of crossroads, okay? And at a crossroad you would have 3-4 shops. Okay? We call them kavela. So you go to so what we did is we told our salesmen, you go to these rural markets or semi-urban markets and you add new customers. So he would go to this kavela or this crossroad, and they would, let's say there are 3 shops, one big, medium, small. So you go to the biggest shop and you would offer credit ready cash, good margins, and you tell this person that look, you can convert some of your Lux soap or whatever products that you're selling into our product, and you would make more margins. So the smart shopkeeper definitely would say, okay, I think I can do about 20% conversion, because we believe that branding is very important, but what we have found is that even up to 60-70% sales happen on, say, the shopkeeper. So the shopkeeper pushes this product, takes it and pushes it. So he says that I'll do 1 case a week. That's my sale, and he starts doing it. But he puts one condition on the salesman normally. He says that don't sell to the other 2 shops, and the salesman agrees to that. So what we saw is steady growth as we increased our coverage, and after some time our growth stagnated. And we discussed with our salespeople, and they would say that their shops are not available, or so on. And we would say, look, there are another 20,000 shops available, 30,000 shops available. So why don't you sell? And they would come to our meetings and they would agree that this can be done, but they would not do it Ultimately, after a couple of months, we found that what we thought they would be doing, they are not doing. Even the sales managers, nobody is doing what we're telling them to do. So me and the director, the son, we went back to the market to figure out what was wrong. So we went with one of the best salesmen along with him, and we reached a Kavela or a crossroad. So we said, okay, 3 shops, great. Which shop are you giving it to? He says, I'm giving it to shop A. What about shop B and C? No. So why don't you give it to? I said, he doesn't give us an answer. So what we do is, let's go to shop B and let's talk to them and see if we can sell. Then he tells us the truth. Then he tells us that, look, sir, when I gave the product to shop A a couple of years ago, there was a condition that I would not give to shop B or shop C. And if I give it to shop B, I'm getting 4 cases a month from this person right now, shop A. Shop B can do 2 cases a month. If I give it to shop B, I won't get 6 cases a month because the first shop will stop buying my product, which means my sale will go down from 4 cases to 2 cases. And next meeting, all the higher management will be asking me why my sales went down. So this was a very, very real and practical problem. So we went back to the drawing board and we, thought about how to solve this problem. Luckily for us, we are a distribution-oriented company. In those days, we have not given any ads. Once in a while, we used to give an ad. The MD of the company, whenever he had money, he would spend some money, and then he would run out of money and not advertise. So literally, we didn't advertise. So and we had improved our manufacturing where we could switch batch sizes and all that quite fast. So what we decided to do is that we thought that if I have a 20 rupee soap, a particular soap with so much margin and so many qualities, we created a second brand, very similar second brand, same characteristics, and we manufactured that and gave it to the next shop. And that is how we had our second phase of growth. So we have multiple brands in the same segment. So we'll give one shop one brand and we'll give the second shop the other brand. And in certain cases, we have up to 3 brands in the same segment. And this works for us because we don't advertise. So if you're advertising, then obviously, doing mass media and all that, you would like to reduce your number of brands, what we call power brands, and spend more money on each brand. So since we were not into that, we were able to, come up with multiple brands and, offer margins to each of these shopkeepers. Because shopkeeper's biggest problem is that he cannot take margins if the shop opposite to him sells the same product at a discount, which would normally happen. So now when this happened, we realized that high FG stock and WIP is a big problem because as our variety of SKUs went up, our stock requirements were going up exponentially. Instead of having, let's say, 8 SKUs, now we're going to 16 SKUs or 20 SKUs. The stock levels that we have to keep go up even higher. And of course, with higher FG and WIP stock, it allows near to expiry products to reach the customer. Because production is made, we label it, keep it in the FG for about 2 months, then it goes to the shop in bulk in the old days, and there it also lies for a couple of months. And by the customer buys it, it's close to expiry, which is a negative in the long run. So what did we do to solve this FG-WIP problem? In simple terms, I won't go into much detail because that's a different topic. We accepted that only bottleneck areas should run at 100% capacity and all other areas should run at less than 100% capacity. So initially our bottleneck area was sales. Okay. So we would switch our production as per the sale requirement. But what we did also was that we reduced our setup time from 1 day to 15 minutes. And that was totally done internally by our team. Because it was very funny. We have technical consultants coming in to advise us on quality and productivity in terms of machinery and process. And most of them have worked with levers and Godrej and PNG and all that. And what we found was that their mindset was they were not focused on setup time reduction. Because these big companies, setups were very rare. They had high volumes. One plant was dedicated probably to one product or one brand. And so the setups were very rare. In fact, they used to come and tell us all the time that, why are you, doing so many setups? You reduce your setups, so your efficiency will go up. So the problem with us is that we had one plant and we had so many SKUs. We were operating only in Kerala. So our volumes are not so high. We can't have, a plant dedicated for a particular product. So we had to internally ideate and come up with ideas to reduce the setup time. We hardly got any help from external consultants or technical consultants. We reduced it today. We are in the soap line. We are able to switch from one SKU to the other SKU in 15 minutes. So with that concept, we started switching as per the sales. We increased our SKUs, sales went up. Then sales no longer is the bottleneck. Our bottleneck became our packing machine. And we ensured that our packing machine was running at 100% capacity at all times. A lot of theory into that, not getting into it that way. And that enabled us to reduce our WIP, because if you look at this graph, this chart that I'm showing, if you have a bottleneck, let's say C is the bottleneck machine, and you run all the machines at full speed, then after A and B, the other machines, you will have high WIP. Okay? And because we were willing to switch make to requirement, rather than make to stock or make to forecast, we were able to keep our FG much lower than required, because anytime we ran short, the production was willing to switch and produce the new product immediately. Okay? So that kept our entire FG much lower than what we were doing in the past. So that's how we solved the FG and WIP. So we do not insist on large production batch sizes anymore. We are willing to change over according to sale pattern. We focused on reducing our setup time, as I mentioned, rather than setups. And we do not insist on 100% capacity utilization by making stock. Rather, we focused on solving the real problem in sales. With relation to raw material stock, what we found is the reasons for holding high raw material stock were most suppliers, although they have excess capacity, and the actual production time is still only a few hours or days. And in fact, most of our suppliers were located in the same country. Our focus on reducing prices led to bulk purchase. Our purchase managers were mostly focused on reducing prices. So they would, when you go talk to a normal company for reducing prices, it's like what we used to do with our customers, bulk offer. They would also tell us, you buy in bulk. So we also found that transport costs are normally borne by suppliers. So we quote for ex-factory, our ex-factory price. So the cost of transport is on the suppliers. So what do? They use the least cost option, which is normally the slowest. They take the slowest transport, so the slowest means of transport, which is normally the least cost option, which leads to long lead times, which again makes us uncertainty. We don't know whether we're going to receive it in 14 days or 20 days. So we are forced to keep higher raw material stock as a buffer. Also, suppliers are unreliable, as we do not build long-term relationships. We keep on changing suppliers. So if anyone offers us a better price, we switch to that person. Somebody else offers us a better price after some time, back to him. If the original person again offers us a better price, we switch to him. So we don't have a relationship with suppliers. It's all transaction-based. So again, why is high RM stock unhealthy? Apart from the funding issue, it leads to high obsolescence, carrying costs. When we hold too much raw material, our lead time to phase out old products and introduce new products is very long. This is a very interesting case, which I can relate to this company. In 2000, I don't know whether you all remember, 2006, 7, 8, the commodity prices went up before the recession. And so what happened is that, like soap, we're buying commodities, oil and all that, our costs went up. So let's say we're selling a 20 rupee soap at 150 gram, MRP 20. We found that the costs are going up, our margins are going up, so we need to increase the price. So a discussion was made and the price was increased to, let's say, 22 rupees. Immediately, we found our sales dropping dramatically. So we were surprised. We asked why, everyone should have increased their price. Why are our sales down? So when our sales force told us that people like Hindustan Lever, for example, they kept the same soap price at 20 rupees. They didn't increase the price. So 150 grams soap, they shrunk it to 125 gram or whatever proportion required. And they kept on doing that. And as the commodity prices went up, they kept on making the soap smaller. But they kept the price at 20 rupees. And that was a very, very smart move, because you're a customer, you're used to buying 20 rupees soap. And suddenly somebody says the soap is 22 rupees. So you'll say, no, I want another 20 rupees soap. So you have Levers, which is a premium brand, good brand, selling at 20 rupees. Hardly anyone checks the grammage. So we had the discussion, okay, why don't we do the same thing? and we have to change the mold and all that. That's fine. But the biggest problem we saw was that our purchase manager told us that, sir, we are sitting on 3 months of old wrapper. We buy the old wrapper in bulk to reduce our price. So we have 150 gram old wrapper stock, 3 months of stock. So we can only change over to the new, let's say 125 gram after 3 months. Okay, so this is a problem when you hold too much RM, raw material. You cannot phase out old products and introduce new products. Takes a long time. And of course, high raw material stock also causes us to limit the variety of products we offer, because as variety goes up and we need new items, if we hold too much stock, again, exponentially our requirement goes up. Same problem about near to expiry items. That quality is a problem if you're holding too much of high raw material stock. It tends to degrade our quality of our raw materials, which impacts our final product. And what we found is, in spite of holding high raw material stock, we run out of RM stock from time to time, as our suppliers are unreliable, which leads to lost sale because we are unable to produce. So how do we solve this issue? Very simply, we went for a high frequency, low lead time model, which is we focused on price, lead time, minimum order quantity. We're trying to reduce the minimum order quantity so that we increase the order frequency and defect percentage when negotiating with suppliers. And we increase the frequency of ordering from suppliers to the maximum possible. If possible, we would like to order daily. And if you're ordering monthly, the first step is to go fortnightly and ultimately to go weekly, and if possible, twice a week. And this was helped as we grew in volume also. So we worked with our suppliers to reduce their production lead time, and we built a long-term relationship with suppliers. And one important thing was our design of new products. Initially, our design of new products was limited to the marketing and sales. They used to tell us what was required, and it used to be designed based on inputs from them. Ultimately, we realized that each product has a problem in production or issues in production as well as supply. So what we used to do now, what we do is, whenever we're designing a new product, the production manager as well as the suppliers involved are taken into confidence, and the product is designed along with them, meeting the marketing and sales expectations, and also ensuring that we have high productivity in production, and also our suppliers also have high productivity. So this has helped us because of this long-term relationship with our suppliers. So we had a very successful outcome, and the old business practices that we had made us invest 30 crores to run a 60 crore business, as I mentioned at the beginning of the case study. By changing our business practices, we were able to substantially reduce our investment. Our market credit went down to 1 month, which is about 5 crore. Our finished goods, I'm assuming the sales is the same in this particular example. The FG and WIP stock went to half a month, where that's about 2.5 crore. Our raw material stock 1 month, because we still had imports coming in. And because of that, the total investment required in the business is now 12.5 crores. And we had an equity of 15 crores. So there was no need for loans. And this is a simplified example. But over a period, we were able to pay off all our loans and still grow at a 20% average rate. So this method gave us a very high and sustainable ROC. So if you look at the same example, our net profit now is 5.1 crore, which for a 60 crore turnover. It's 3.6 crore plus the loan interest. We are no longer paying any interest. So now we have a profit of 5.1 crore. Our investment is only 12.5 crore. So ROC is now 5.1 divided by 12.5, which is 40.8% per year, which is a decent, good ROC in my view. So this is what we were able to do. We grew by 30 times, average growth of 20% per year over 15 years. And we went from a high debt company to a zero debt company. And we are competing with multinationals and big companies like Levers, Godrej, Jodi Labs, Procter & Gamble, and so on. Okay, so it's not it's not that we have a monopoly market, or we are the only players in the market. We're very competitive and we're growing extremely well. In fact, in the last quarter, which was the COVID quarter, April, May, June, we did our highest all-time sales, okay, which was quite surprising for us, because we did have production constraints, labor shortages and all that, but we were able to do our highest ever sales in this pre-COVID, in this first quarter of COVID. And we're growing quite well even today. So let me wrap up my presentation by giving you a few examples of zero debt big businesses. Okay, there are a lot of significant number of big businesses in India which have low debt. So I've tried to identify businesses which have actually zero debt, because the concept is zero. We don't want even low debt, and there are a few. Let me just list out what I think are currently businesses in India which are having zero debt. One is Hindustan Lever, Colgate Palmolive, Swaraj Engines, Castrol India, Dr. Lal Path Labs, Grindwell Norton, Kalyani Steels, and SKF India. So these may change from time to time. There are a lot of other companies like Bajaj Auto and so on, but I find that they have some debt, a little bit of debt, maybe very little, but so I've not kept them in the examples. But I would request you to look at these companies and get inspired by these examples, and also look at what I've talked about and see whether that kind of approach is appealing to you and whether it's practically applicable in your business. So thank you for listening to me for the last nearly 2 hours, and I'm happy to take questions. So I think Samir Mumtaz will take over. Thank you very much. Hello.
Hello. Samir, Mumtaz. Yeah, can we have the question answer session?
Yeah, sorry, my mic was mute. Thank you, Mr. Philip, for such an intriguing and informative session, providing a glimpse to the fundamentals of contrarian business approach. And this session is just the tip of the iceberg, people. So after this session, if you have that strong feeling and the need to further gain in-depth knowledge about this topic, so that you can incorporate its fundamentals into your existing or the new business, we are pleased to inform you that Mr. Tini Philip has planned subsequent sessions of around 2.5 hours to 3 hours for 2 days, November 6th and November 7th, 2020. I'll repeat, November 6th and November 7th, 2020, at 8 p.m. in Oman, 7 p.m. in KSA, Bahrain, Qatar, and Kuwait, and 9:30 p.m. in India, which could cover this entire business approach, which Mr. Tini Philip has just presented. And these sessions are available for very reasonable fee. The link to register or to join the WhatsApp group are provided in the chat. So what are you waiting for? Please register and make a note of it. Now we shall proceed with the QA session. I think most of you all must be waiting for the QA session. So now there are two ways of asking your questions. One is by raising the hands, and one is by posting your questions in the chat box. It will be on FIFO basis, first come, first serve basis. And please do not duplicate the questions. And I request the participants who are asking questions, by like voice, please restrict yourself to asking one question, and let us not give our opinions. Let us ask the question and let us allow our speaker to answer them. So we can proceed. If people are interested, you can raise your hands and we can ask questions from you. You can raise your hands. Are you able to raise your hands? If anyone is having an issue, please mention in the chat box. Are you able to raise your hands?
Samir, but there is a question in chat box.
Yeah, it's just come right now.
Yeah.
Okay.
Is it applicable to production-based companies or any business?
Yeah. Mr. Tini Philip, the question which is asked is it, this approach which you are talking about, is it applicable to production-based companies or any kind of business?
It's applicable to most companies. Can you hear me? Yeah. I've not really,
Yes.
I've not really seen an instance where it's not been applicable. If you have production, obviously your WIP is an advantage. But let's say you're a distribution business, you have finished good stock. Okay, you have credit. So those things are still, you have supply credit. So those are applicable. Even a service business, you're an architect, you have credit, you have working capital requirements. So I think to some extent it is applicable to virtually all businesses. But obviously it's a little, there are more things you can do in a production related business because you have the factory also. Okay, but it's applicable for virtually all businesses.
Yeah, this question was asked by Shafakat Hussain. The next question was asked before by Mr. Suresh Joseph. He talked about, zero plans. Will it not affect the financial services sector? Because governments also promote bank lending and attractive interest rates as a stimulus for economy revival.
The contrarian approach is not followed by the mass of people, right? So my belief is that even if I talk to maybe 100 people, I'm sure that maybe only 5 or 10 people would actually take up this approach because it's not popular. So I don't think that by propagating this approach, the entire country or the world is suddenly going to become contrarian. Then it would become popular, right? So my belief is that it's not going to affect them much. It's a negligible portion, but the thing is whether you want to be part of that stream or you want to be part of the popular stream. As I said, this is a very difficult path. It's not easy to maintain this. You will be brainwashed. So Mr. Suresh Joseph's question, I actually don't believe everyone is going to follow this approach tomorrow. What I have experienced, I've gone through several recessions and slowdown over the last 28 years, and what I have seen is that during recessions, I'm very popular. People are willing to listen to me. But during boom times, very few people are willing to listen to me and implement. Which is I'm okay with that because I cannot consult for everyone anyhow. And I tell my clients that it's good that only few people are using this approach. Otherwise, we would have to come up with a new approach, right? So to answer his question, I don't think this approach is going to be very easily, implemented by everyone across the world tomorrow. Okay, so and therefore it should not affect the financial companies and so on.
Yeah, and before the session as well, there was another gentleman asking about ROE and ROCE. Just explain in a much simpler manner to understand.
Yeah, so ROE is like if you put in 10 crore equity into a company and you make a 1.5 crore profit in a year, then your return on the equity is 1.5 divided by 10, which is 15%. That's what I mean by ROE, okay, equity. Unfortunately, now, since, as I said, most companies take loans, right? So just focusing on equity alone doesn't give you an indication of how efficiently they're using their money. So therefore, this concept of ROCE, which means equity, you take the profit as the numerator, let's say the same example, 1.5 crore, but instead of 10 crore equity, probably it's 5 crore, equity and 5 crore debt. Okay, long-term debt. So we have to consider both as part of the denominator, and then only we will get the better realization of how this company is using its money. Okay. In fact, I had mentioned that my definition is even more stricter. I look at short-term debt also, and I also add supplier credit. So let's say we are doing 5 crore equity, 5 crore long-term debt, and you have 2 crore short-term debt and 1 crore supplier credit. Then I would add. Then it will be 5 plus 5 plus 2 plus 1 in my case. So it would be, I don't know, 13 crores as the investment. So these are all measurements just to understand how much you're rotating your money, how well you're utilizing your funds. Because see, in the past, funds were a constraint. Okay, when 20 years ago, 30 years ago, funds are a constraint. But today's people seem to believe that funds are no longer a constraint, so we don't really need to, focus on this aspect. But in my opinion, any business utilizing your funds in maximum efficient way is actually one of the key success factors. And so you need to look at measurements like ROCE. In fact, in the way I look at it, which is even more stricter, where we add short-term debt and supplier credit to the denominator. Okay, so I hope that explains what we mean by ROE and ROC.
The next question is from Mirza Beg, Mr. Mirza Beg. He's asking, e-commerce is the biggest challenge for retailers. What's your opinion on that? How to overcome that?
Yeah, e-commerce is a challenge because most retailers have really not woken up to the fact that they can also do e-commerce, right? So with this COVID, what we are seeing is that everyone has suddenly realized that we need to also get into e-commerce. So my retail clients, we have been pushing for online sales and e-commerce sales for years. And it's difficult to convince people to get them on board. Now, if you look at Amazon, Amazon is only a fraction of the total e-commerce market. Okay. If you look at Swiggy, it's also a fraction of the total sales that are happening in market. So I have a restaurant client in Calicut. We are the largest player on Swiggy in that market. But what we are also doing is we have been parallelly building up our own distribution, and we're not stopping Swiggy because Swiggy is there. Swiggy we should use, but Swiggy takes a large portion of our profits. In fact, literally, to some extent, I think we are doing zero profit, zero loss on Swiggy, right? But we can't eliminate Swiggy because during COVID that was a great boost for us. But what we are now actively doing is we have a good brand name, so we're actively building up direct link to customers, and we're doing direct ordering and direct supply. The problem with everyone is that everyone thinks that you should replicate Swiggy. Okay, now, and you come with your own app. Now, most people would not download a single restaurant or single shop app, or even a single hospital app. Okay, we would only download apps and keep them of aggregators. Okay, so if you're that's not the way to fight them. Okay, just to give you an example, I have a hospital. The first thing when we implemented software about 6-7 years ago was a lot of people said we should have an app. So I said, look, how many people would keep that app? Okay, so we developed an app, but we didn't really use it for the outside patients. We use the app for the patients who come in, internal IP patients. So if you're an IP patient with an app, okay, you can do everything, right? So that's how we first used it. We have all the booking and everything, but we found that hardly anyone was using the app. In India, booking is like you call up and you get your booking, you get your SMS and all that. That's what 90% of the people are doing today. So direct communication. So similarly with this restaurant, what we are doing is we are actually advertising on Facebook, Instagram, SMS. We're getting direct calls, okay, and we are interacting with those people, and we are getting orders directly, because Swiggy guys will order only on Swiggy. So that we can't tap. But there's a whole host of, I would say 90% people in Calicut city, Kozhikode, where I stay, are not on Swiggy. Okay, so that's the market we are trying to build up. And definitely e-commerce online is an issue. It was growing. If you look at our purchases, my online purchases have shot up over the last COVID last 6-7 months, and I probably will plan to continue most of my online purchasing to some extent. Unless that is a given. But how do you tap into that? It's convenience. Okay, so people need to be able to call you or contact you through WhatsApp. There's something called WhatsApp Business now. We believe that WhatsApp is coming up with a platform where it will compete with all these kind of applicants, where we can host our own site directly on WhatsApp and they can order directly. So we need to look at that. So the answer to that question is yes, e-commerce is a threat, but it's an opportunity. But you should not go head to head with e-commerce players. That's the big mistake everyone is making. Going head to head. Okay, it doesn't work. You need to figure out, the vast majority of people in India still want interaction before they purchase online. I'll give you a very simple example. I have another restaurant where we tried all this out, this e-commerce and all that. So we put up a site, we drove people to the website, okay, and we found our conversion was 0.1%. 0.1. Okay, people are going to the website and then not completing, because in India, the vast majority of people are not used to buying on website. Okay, so I think we make a mistake. For example, when websites came to India, I was an adult, and I started off using websites. Okay, so I buy on websites. My son doesn't buy on websites. He doesn't go to websites. He's app or whatever, or Instagram or Facebook. That's it. So we are seeing most people are not actually website friendly people. They don't like to go to the website. So what we are doing, for example, in a jewelry shop that we're doing, what we are doing is we are generating inquiries about designs. Then we are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on Instagram. We are talking to them on Facebook. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on WhatsApp. We are talking to them on Facebook. We are talking to them on Wha And then we're pushing them to the website, and then we are making them buy, and our conversion is much higher. Okay. Another example I can give you is that recently I'm a venture capital fund partner also. So we had a firm come to us for funding, and they were into telemedicine app. So it's a good product, good thing. So they were focusing on teenagers, youngsters for acne and hair fall. Hair fall. So you go log on, you give your diagnosis or you answer questions, you take photos, goes to the doctor, dermatologist gives you a gives a diagnosis and medicines are sent. Good app, no problem. So I asked him, this promoter, what is your conversion cost to, they said we are very good on Instagram, we are generating a lot of leads on Instagram and all that. So he said, when we worked out, the conversion cost was 1,200 rupees for a new customer. That is, spend versus new customer was 1,200 rupees. His consultation cost was 400 rupees. Okay. I asked him, doesn't this sound a little odd? 1,200 rupees to get a consultation of 400 rupees. So he was saying that, look, I have this whole product which I'll sell. My value of a customer is going to be 5,000 rupees. So out of that, I can afford to pay 1,200. So I said, great, that's a good answer. So I said, are you thinking about reducing your conversion cost? So he said, no, we are the best. So he talked about Practo and so many other similar telemedicine portals. And he told me that as per their research, 1,200 per customer was the best in the industry. Okay, so he felt that that was not a priority area. So I work with a normal hospital. I told you, for example, in Calicut, and we are doing telemedicine. We've been marketing telemedicine for nephrology, neurology, and all that for old patients. They don't come to the hospital during COVID. And we have marketed and got patients for 50 rupees. Okay, so this is the difference. Okay, so the point is, I cannot afford to pay 1,200. I'm not a startup. I'm a hospital which I need to make profits. So for us, the range was, even 50 rupees is too high. Okay, our consultation cost is 200 rupees. But we are now bringing it down. So this is how we are looking at it. So he's looking at it differently because he's being funded. He's running a loss. For him, 1,000 rupees, 200 rupees is okay, scaling up. But if you're a profit-making business, you can't afford to. I can't afford to do 1,200 conversion cost for a 200 rupee consultation. Okay, I lose money. The board of directors will chuck me out. Okay, so what I'm trying to say is that we have to be smart about e-commerce. We are not a funded platform. We are not an aggregator. We are not Amazon. So we have to think differently, utilize their weakness. And their weakness is they don't interact much. Okay, that's the biggest weakness I'm seeing. There's no interaction. And for us, people are cheap, calls, phones, WhatsApp. If you interact with people, you are able to generate significant sales. And that's what we are experimenting with right now. And I believe we can really scale it up. We're still in the I'm not able to give you a conclusive answer, but that's the direction we are actually moving to, because we're very clear that we cannot fight head to head with somebody who is willing to burn 20 crore a month. Most of us can't do that, right? So we have to think differently. I hope that sort of answers the question.
Wow, it definitely, for me, it did, mashallah. It was a very good answer. The next question is from Mr. Kalimullah Sahab from Jeddah. How good is the contrarian model approach for a new startup? Even I need to know that. A customer item manufacturing.
It's extremely good because in fact, when I was discussing this program with Shah Jahan initially, he had told me that a lot of professionals are in this group. Entrepreneurs are not. It's not. I normally talk to entrepreneurs. I told him that my message is for entrepreneurs, not for professionals per se. Then he told me a lot of people are thinking of starting their own business or have so I said, okay, that's the way we can look at it. So what today's meeting is all about is that I'm presenting an alternative approach. Okay, because what probably any one of you who are doing startups or planning to do startups have only been exposed to one side of the story, which is you take loans, you grow, you do this, you do that. There's so many things. Nobody has been exposed to the other side. I don't think most of you have been exposed to what I have told you so far. Okay, maybe some of you have, but I'm sure most of you. So it is applicable to startups because normally startups are bootstrapped. We don't have money. Okay, I started my business with a laptop, a phone, and a printer. Okay, that was my savings. Okay, I worked for a couple of years and then started my consulting business. That time I had to invest a couple of lakhs because a laptop used to cost a couple of lakhs in those days. Okay, so I bootstrapped myself. So virtually all, people have to do bootstrapping. It's like you have your own savings and that's it. You don't really, or maybe close friends and relatives. It's very few of us, who get angel investors and all that kind of stuff. Okay? And if you look at that, is the best way to do business, because one statistic that I'd like to share is that established businesses that start new businesses, the failure rate is very high. When I say, if I'm an established business, let's say I'm a jewelry business, and I start a developers or a builders, okay, once I'm big, you find that it's not profitable. Most of the established businesses, most have not been able to successfully start a diversified business, and it looks successful because that business is still running. And the reason it's running is they're funding it. Okay? It's not running on its own. And the problem why, when I analyze that, the reason is that now let's say you're a 1,000 crore company or you're a 100 crore company, you're a big person in your society, well-known big businessman, and you decide to start a totally new business. Will you start small? No, you will never start small, because you will need a corporate office, you will need GMs, you will hire all people. Because if you start small, everyone will ask you, why are you starting such a small business? You're such a big person. Okay, so when you start a big business, you have huge overheads, you don't have a proper business model, and you start losing money from day one. Okay, so when you start small, you make all your mistakes, but you have very little overhead. So what happens is that you're able to manage, and you're very, you understand your cash flow. You don't have access to support. There's no mother company to keep on pumping funds and give you. So you have to figure out the right way to do business or close down quickly. Okay, so what I'm saying is startups also, I'm just exposing you to this alternate approach, because once you get into this debt cycle, it is not easy to get out. Okay, it takes a lot of effort. So if you're able to avoid getting into the debt cycle uh, from startup stage, then what happens is that your life becomes much simpler. So it is applicable it is very, very applicable for most startups, because most of them don't have the money to, to really grow. So you really need to look at high ROCE. Whatever 1 rupee you invest, you have to be able to generate the maximum return.
Just associated to the same question, there is Mr. Jasim Ansari. He's also talking about a startup of a footwear manufacturing company, but he is adding that he wishes to go for government subsidized loan like PMEGP, yeah, PMEGP. So should he go ahead?
That's a difficult, it's a very good question. See, government grants which don't require repayment, no problem, please take. Government loans which require repayment, I would normally not advise. So the issue is that we're thinking big, right? So the fund, he has, Mr. Jasir, right? He has a certain amount of funds which he has. Jasim, yeah, he has a certain amount of funds, I'm assuming, which he can invest, and his project report or his project requires more funds. So thereby he's looking at the bank, the government loan. So my point is that, that would not be the right way that I would look at it. Either he should cut short, make his project, within the budget that he has, or he should get investors or somebody like that, real investors, not, fixed return investors, but investors, close friends, relatives who are willing to share in the profit and loss kind of concept. Because if his idea is good, if he is a good person, a credible person, he should be able to generate those kind of initial investors. It's not a big issue. Okay, but if he is not credible or he doesn't have a great idea, he won't get the investors, which will prevent him from, starting a wrong business. Okay. Let me just give you an example, because a lot of people would think that, how can I do this? I need a factory, or, without, like you're saying footwear, right? You need to start a factory. There's a minimum investment. The company that I talked about, FMCG company as a case study, 10 years ago, they decided to get into food. I was against it. Okay, so I said no. Food. We debated for a year, and then finally, because the food market is much larger than the soap and detergent market, so they thought, why not get into it? So my concept was, the food margins are lower than the food and detergent margins. It's very simple. 20 rupees soap is only this much. Okay, for maida or atta, 20 rupees is like this. Okay, so transportation, everything, the costs are very high. You want to go for 50 kilogram rice. Okay, imagine what is the margin in it? There's no margin, right? So what we did was, we discussed, and finally we eliminated all these bulk products. So I got them to figure out that, okay, we'll go for value add, curry powders, jams, squashes, and stuff like that. So the initial thought was we'll get into rice and all the food is like that's huge, right? So that was the first decision. Great. So we narrowed it down. The second issue then is the MD. The father said that he's very quality conscious. And at that point we had a lot of money. We're doing very well. A lot of money is not an issue. Zero debt. So he said we'll put up a big food factory. We quality food. We have to be very quality conscious. So we have to put our own factory, and we have to ensure that we give the best quality supply to our clients. So I told him, look, sir, the problem is that we are launching small. We have distribution. 80% of the customers we know. We're already dealing with them. So we are actually in a very much better position than most startups. Okay, but we want to start small. We don't want to make the mistake of starting big. So we are going to start distribution. We're going to put a van, one van, two vans, and we're going to start small. We're going to lose money in distribution for many years, and then we're going to scale up, correct ourselves, scale up, and then we will put up the factory. Okay, but then the factory will also become profitable from day one. We had a lot of arguments on that, and finally, he was like, "Without factory, how can we do?" So that was, I'm sure Mr. Jasim has the same issue. So if it's a factory, so I finally convinced him by telling him that you'll go to jail. He was surprised. That why I said we have a FSSA Act in India. Okay, the MD goes to jail if something goes wrong, right? And you put up a new factory. We don't have anyone who knows food. We're going to hire any Tom, Dick, and Harry technologists and technical and people, and we don't know them. We're going to trust them, put them in the factory, run. And if anything goes wrong, and food safety is a big issue in Kerala. We will, you may be arrested. So that was what actually got him to stop, because he was still very keen on putting up the factory. And anyhow, we stopped. We outsourced our production for 9 years. We outsourced jam, we outsourced squash, we outsourced curry powder. We paid that profit to the manufacturer. We knew that they were making a profit, right? We know that, okay, there's a margin there. And we distributed and we increased our sales. So we ran a loss in distribution, but we scaled up distribution. We had no problem with quality, and because we could reject, we come, inspect, if it's not good, we will reject. And manufacturing is by them. So all the risk is on the manufacturer, and they know their business. So they would not obviously, compromise. And as we grew our sales, after about 7-8 years, they were unable to give us supply because they have their own brands to do, right? So when it was small, it was okay. And then finally, we put up a factory 2 years ago, full-fledged factory, and that factory was profitable for day one. Okay, so this is a company which group turnover is about 800 crores now. Okay, so 800 crore company did not put up a factory on day one. Okay, so we did it after 8 or 9 years. Okay, we focused on selling. So my point to all of you is that when we start businesses, a lot of people have this production orientation. Okay, my point is if you can sell something, you can always outsource from somewhere. And once your sale is big enough, you can always put up a production if required, because sale is the current constraint in most companies. So 20 years ago, production was the problem. But 30 years ago, 40 years ago, there was no product. So if somebody makes a product, then people would buy. But today, the problem is not production. You have excess capacity everywhere. Outsourcing is available for anything. Okay. So the problem is selling. So if you're starting up a business, first get your sales in line. You can always, most of the time, you can outsource. And once you are able to successfully sell, then you can put up the factory or back end. And that's where most of the investment is, in my opinion. I hope that sort of answers the question that was put to me.
Mashallah, that's good. There's another question by Fazil Saifuddin. I think you answered it, but just in a simpler manner. Why finance professionals advise to take small loans in business by paying interest to reduce tax payment? Please advise.
Yeah, that's a big confusion for me also. A lot of people advise me the same thing. So I don't understand. For me, for example, I'm making 100 rupee profit. Okay, and I have to pay 30% tax. So I get 70 rupees net. That's what I understand. Now I am told you buy a car, a BMW or whatever, you take a loan and you pay 10 rupees interest, let's say. Okay. So now your 100 rupee profit minus 10 rupee interest, 90 rupees. So now you only pay 27 rupee tax. So 3 rupee tax saving. That's the calculation that is put by finance professionals. So now what happens is that my profit after everything is 100 minus, interest 90, 90 minus 27, okay, which is below 70. Right? So I don't understand where the benefit is. Yes, I'm using an asset, maybe that is, but for me, I'd like money in my hand. So I'd like to get 70 rupees in hand, then accumulate it and buy a car. I buy my cars on ready cash. Okay, I don't take even car loans because I sort of believe in that philosophy addiction. Even if you start on car loans or home loans or something, immediately it will translate into business loans. Okay, so I'm like very happy. COVID situation, I have zero liability. Okay, recently somebody came to sell me term insurance. I said, look, I don't have any liabilities. I only have assets. Okay, so I don't have that pressure of tension of, having to ensure that my family is not having any liabilities. So anyhow, to answer your question, I don't get that logic. I think that you should make money and then spend that money to buy whatever asset you want. And it's a little slow, but you'd like to make more money, right? So you make money faster. You make your ROC higher so that you make more money faster, so that you can buy your things faster. But once you buy, you sell. You buy and you keep it. I invest in some companies. I have shareholdings here and there, and some of the finance managers and the partners tell me that. So you're the only, virtually the only director or shareholder who pays his shareholding on time. Like 20th of November is the payment date. 20th of November, my payment is reached. So they said that people who are much bigger than you, who are asset wise and money wise, and they pay late. Okay. So I said, look, there's a difference in philosophy. If you give me a commitment, ask me for a commitment, I will look at my free cash flow, money in the bank, and then I make the commitment and I keep that money aside. Very inefficient. But I don't have the time. I cannot, spend the time trying to do cash rotation. The other people are, they look at future income and then they do a calculation. Sometimes it works, sometimes it doesn't work. Okay. So anyhow, point is that make money and then buy your asset, enjoy peace of mind. That's the concept that I have.
I have
Mr. Mumtaz Kanal, we have 8 minutes more for the question answers and we'll wind up. Yes, Mr. Mumtaz, please go ahead.
question to ask. This is regarding the loan which is being given by the Qatar Development Bank in Qatar due to COVID. There was a lockdown for about 2 to 3 months. So many companies suffered. I mean, due to reduction in the business. So government announced a corporate loan scheme which is called NRGP, National Rescue Loan Plan, something like that. So what they say that they will pay 6 months employee salary and the real estate rent, your office rent, labor camp, warehouse, whatever the rent you pay and whatever the employee salary, they pay for 6 months. Every month they pay. So once 6 months is paid, after that, within 3 years, you have to. It's a 3 years, 36-month repayment tenure, including 18 months grace period. So what they say, for 18 months you don't pay the interest. The balance 18 months you have to pay the interest. So what is your advice?
See, when you're a businessman, you have to be practical, right? So if you are in a situation where you have to take that loan, you have to take that loan. So the point is that you cannot avoid this situation unless you are strong before the recession, right? So if you had reserves, you had capital, you already, you are not having, you are able to maintain your sales during this COVID lockdown also, because we had lockdown here also. We were able to manage. We have the same issue in India where moratorium is there, right? 6 months moratorium. So my point is that if you're forced to do it, you have to do it. If you don't have the reserves and surpluses built up earlier to avoid this kind of situation, obviously, to survive, you have to take the loan. So my point is that it's a very difficult question to answer, because if it's needed to do, you have to do it. I mean, otherwise you would close down, right? In case you can't do that. So if you're able to avoid that, you should avoid that. Recently, one of my clients here was this moratorium. The bank came and said that we are increasing, we are willing to pay you another 20-30% loan additional. Okay, and there's a 1-year moratorium on that. So we didn't need the loan, but he was saying that should I take it? So we didn't need it, so we didn't take it because the EMI after 1 year was much higher. Okay, because accumulated, right? 1 year grace period. So since he didn't need the loan, we said no. But if you're a company which actually you cannot do without that loan, then I mean, my answer is I'm practical. You probably have to take the loan and see how you can get out of it. But hopefully in future, you should be in a position whereby when these things happen, you can possibly avoid, because COVID lockdown was something which is like unprecedented, right? We could hardly anyone could predict such a thing. So this is exceptional circumstances. I wouldn't say don't take it or do take it. If your circumstances require you to take it, I think you should take it and then make sure that you get out of it as fast as possible.
No, I have decided to take it, but I have also decided to return within 18 months so that I will not pay the interest.
Great. So, I mean, I'm just saying that, for survival, if you have to take it, you have to take it. And even if you have to pay interest, you may have to do that because, for survival, if there's no other way, because this is a special case, right? But as you said, your plan of paying within 18 months is great. Make sure that your business is able to do that. That's where your focus should be.
The next question is from Mr. Mohammed Salah, where he says, what are your views on Islamic banking and financial support which believes in profit and loss sharing?
I'm very for it, but the problem is most Islamic banking today is not that way. It's fixed lease, asset collateral, and stuff like that. That's what I am seeing in the market. So pure profit sharing is very low. The portion is the organized sector of finance doesn't follow that model. In my opinion, most of the Western banks and what we are seeing is they call it lease, but it's fixed. It's fixed interest, in my opinion. So if the model that he's talking about is great, profit and loss sharing, that's the best model possible.
Okay. Yeah, I think that's the questions which we are there. I'm just scrolling through if in case I've missed any. Uh, there's one question from Mr. Ahmad Ashraf. I'm not able to understand. He says he's thinking to go back. That means maybe he's going back to home country. What type of business he should look into, and what type of government support can he expect in India? If I'm not wrong, Mr. Ahmed Ashraf has asked this. He's thinking to go back to India, and what type of business he should look into, and what type of government support can he expect?
I think in India, you can't really expect too much of government support, in my opinion, because what is happening is the government is constrained for finance, right? They're planning some schemes right now, but most of the schemes are really nothing great. It's all loans or credit and which you have to repay. What advice? I don't know which part of the country he's going to, or which country it is. But what we are seeing, for example, in my home state of Kerala, one of the best businesses that we are seeing is something to do with retail near your hometown. That's the kind of thing where typically most NRIs are able to flourish, a small supermarket or things like that, or you take a franchisee or something. Because if you stay near your home, you can stay at home. Rent is not a problem. You don't need to, pay rent, and you have knowledge about that market. And a lot of people are doing distribution, small vans. I'm seeing a lot of people. I mean, I'm not talking of high professionals, but I'm saying working class people, and we are seeing a boom in that. And there, people are buying a vehicle, second-hand vehicle, and doing distribution nearby. So those kind of activities where, see, we are in a recession, so cost is a problem, right? Pricing is a problem. So you need to your salary, you need to be working actually. You can't be just sitting on as an investor and managing people. That doesn't work for a small business today. So Like for distribution, when we give distribution to somebody, we are saying that if the owner is actually the salesman, it works. But if the owner is sitting in office and then he buys 5 vehicles and sends out the salesman, the margins are not there for small distribution. Or if you're in a shop and you're the sitting in the shop and you're actually doing the selling, small shop, yeah, that the salary that you would pay plus the profits would keep you your family in place, and the risks are low. So you should obviously not invest your entire funds into any business, because if you fail, then you have lost all your funds. A proportion of funds in this, you can also look at a lot of companies require investors. They're looking for working partners, in my opinion. Many businesses, in at least in India, Kerala, they have a problem with funding, right? They have fund. The last few months, many people have had a loss. So there's a big opportunity for you to identify a good business which takes partners, invest a running business, which is already running. You have the track record. They've done badly in the last few months, maybe. So you can invest a bit of money, run one of their shops or one of their areas, and do a working partnership kind of with minimum investment. So I would suggest that would be the ideal thing. Existing business, where you have where it's been running and things are, you can check what's happening rather than start up from scratch. Join them as a working partner, especially in the front end. All of them want front end people, sales, retail, distribution, not back end. Nobody's interested in back end anymore because there are too many people there. Accountants, auditors, administrators are not required. People want people to sell. So if you're able to do that, that would be the best option in my opinion.
Okay, I think we've already reached 10:30 in Oman and 12 in India, 9:30 in KSA and Qatar. So we'll wind up the session. I have these questions which are there. We'll make a note of it, people, and we'll try to contact Mr. Tini Philip if he is available, and we'll try to answer to your questions as soon as possible. I kindly request all of you all to join the link, join the WhatsApp group, so that we can, answer those questions in the group itself. So please join the group, and we can answer to your questions itself in that. I request the host to save the chat if you don't mind. Host, please save the chat. So that gets us to the end of the session, and gets to the portion where we have to give vote of thanks. I begin with thanking our speaker, the expert, Mr. Tini Philip, for giving his, in-depth, viewpoints on this whole approach. Mr. Mumtaz Hussain, for his.
Repeat again the workshop the timings. Date
Yeah, I'll
once.
repeat it. I'll repeat in the end. I'll repeat in the end, please. And I thank Friends Together Group Oman, Gulf Education Forum, and last but not the least, all the participants without whom this session would have never been possible. So, as had informed you before, that subsequent sessions are planned with a very reasonable fee by Mr. Tini Philip, and I hope that you don't lose this chance of, getting this knowledge, because this knowledge is going to, if we are getting into business, this is going to help us, create and develop much sturdier business and a better business plan altogether. So it's on November 6th and November 7th. 8 p.m. in Oman, 7 p.m. in KSA, Qatar, Kuwait, and 9:30 in India. So look forward that you please join the link in the chat. We'll wait for some time so that you can join the link and you can join the group. And thank you so much, everyone. Take care. Stay safe. Keep safe. Fi amanullah. Good night to all of you all.
Thank you.
And please give your feedback as well. How did you like this session? Please give your feedback, everyone. Whoever's present, please give your feedback. I think we can wind up. Mr. Shahjahan, Mr. Makhdoom?
Yeah, I think we can wind up. Sure.
All right. We can end the session. Thank you so much, everyone. Thank you so much.
Thank you, everyone.